This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you by...
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
Bad dream. Boeing's Dreamliner faces a fresh crisis as an empty jet catches fire in London.
Tug of war. Good bank earnings on one side, a warning from an economic bellwether on the other, and both could have implications for your investments.
And risky business? More baby boomers are learning how to trade options as they near retirement. But do the risks outweigh the rewards? We'll have all that and more tonight on Nightly Business Report for Friday, July 12th.
Good evening, everyone, and welcome. This was not a good day for Boeing or its beleaguered 787 Dreamliner or for its investors. Shares of the aircraft maker down 5%, keeping the Dow under pressure from midday on. That was when news hit that an empty Ethiopian Airlines 787 Dreamliner caught fire at London's Heathrow Airport. It's the latest in a string of incidents involving a new aircraft so critical to Boeing's future. And that's why Airline Weekly's Seth Kaplan says investors need to pay attention to these kinds of events.
From a perception perspective for Boeing, these things are not helpful. Investors are really going to be looking for some certainty here. They're going to be looking for, is this just the latest thing? Is there something else going forward that we don't know about?
Not helpful, to put it mildly. And as if the fire was not enough, in a separate incident, a Thomson Airways 787 en route to Florida was forced to return to Britain's Manchester airport after a technical problem was encountered on board. All aboard were safe. Officials haven't said what caused the problems on either plane, but investors didn't wait for an explanation. After hitting a 52-week high early today, Boeing shares nosedived. Also caught in the downdraft, some of Boeing's top suppliers and parts makers like Spirit Aerosystems, down more than 2%. And coming up on the program, our Market Monitor guest will tell us whether he thinks Boeing is a good long-term investment.
Well, that news about Boeing overshadowed a real sentiment tug of war on Wall Street today, with some blowout bank earnings battling a troubling warning from an economic bellwether. We'll have more on those bank earnings in just a moment. But what surprised investors was UPS, warning that profits will be lower this quarter as customers find cheaper ways to ship goods. The package delivery company also said it sees a slowdown in the U.S. industrial economy. UPS shares tumbled 6%. And that gloomy news weighed down the major stock averages. But by the closing bell, stocks rebounded a bit and even posted new records. The Dow added 3 points, closing at a new high, and so did the S&P, up 5 points. The Nasdaq added 21 points.
So what is behind that warning from UPS, the world's largest package delivery company, and what could it mean for the overall economy? Hampton Pearson explains.
The latest indicator that the global economic recovery still has a long way to go comes from United Parcel Service, the world's #1 package delivery company. UPS says there's an overcapacity in the global air freight market, and customers are looking for cheaper shipping solutions even if they take more time. Economists say what happens at UPS and its rival FedEx are bellwethers for the global economy.
I do think that the slowdown that we've seen across the globe coming into the summer was more than anyone anticipated. I think most of the transportation companies, delivery companies, expected better, more, and have excess capacity. So, I think they were surprised by all this.
UPS says it's still expecting profits this year to be higher than 2012, including solid growth in the second half of the year. Ongoing labor negotiations is another factor impacting package volume growth, but retail analysts view that as a short-term problem.
I think UPS will rebound and will regain some or rebuild and ramp up on their new customer acquisition again, but that probably was a bit of a soft spot here in the second quarter as well, while as shippers maybe chose FedEx over UPS due to those labor negotiations issues.
Meanwhile, UPS is counting on growth in its ground transportation and small package business in the second half of the year to offset lower profits and slower growth in the global air freight competition. For Nightly Business Report, I'm Hampton Pearson in Washington.
As we mentioned a moment ago, the one bright spot in today's trading, big profits from two banking giants. JP Morgan and Wells Fargo both delivered better than expected quarterly earnings. At JP Morgan, profits surged 31% to $1.60 a share. That turned out to be 16 cents more than analyst estimates. Revenue also better than expected, up 14%. Wells Fargo posted a gain of 19% or 98 cents a share, a nickel higher than expected. Those gains came despite the recent jump in interest rates and the drop-off in lending in the mortgage market. But CEO Jamie Dimon said today his bank, JP Morgan, will continue to do well even as interest rates move higher.
When rates go up, all things being equal, it may knock down mortgage originations. Right. But if you have a healthy economy, that'll filter through all of our books of business. So all things being equal, rates going up is a good thing as long as the economy is growing.
Well, as for the outlook for the U.S. economy, Dimon is also pretty upbeat.
The American economy is slowly getting stronger, so the lending will come back when people have a little more confidence. They start to do more capital investing, and so we're kind of confident that you'll see growth over the years as America recovers.
And we'll learn more about the outlook for the banking sector next week. Citigroup reports its earnings on Monday, followed by Bank of America, Goldman Sachs, and Morgan Stanley.
And here to give us more analysis on those bank earnings from today and a look ahead to next week, Fred Cannon. He's director of the bank research firm Keefe, Bruyette & Woods. Frank, welcome. Good to have you with us.
Great to be on. Thanks.
All right, let's talk first about JP Morgan and Wells. What were the highlights and what were the lowlights in those reports? And there were more highlights than low.
There were. Fee revenues, number one, at both companies, stronger than expected, and also credit. Remember, these companies still have these big legacy asset portfolios from the financial crisis continuing to get better. And let's face it, credit's been tight the last 3 years, so there's been no problem credits developing. So as a result, they're releasing some reserves they made for those loans, and that's a key element to the growth.
So, Fred, do you think we're going to hear the same sort of storyline when Citi reports next week and also Bank of America?
We think so. I mean, remember, I think as Jamie Dimon said in your previous segment, this is actually getting to be a better environment for banking. Higher rates, while yes, there are some negatives, are a better thing because the spread between what you can earn on your lending versus your cost of deposits is widening overall when rates start to rise. The second thing is home prices. Home prices are drifting up in the U.S., and the recent run-up in interest rates isn't dampening that. So both of those things are a good thing, good backdrop for second quarter earnings.
You know, we've seen an awful lot of strong performance from the mid-size and the regional banks. What are they doing so well? I'm not talking here about the big ones, though that's sort of our main focus tonight. What are the mid-size guys doing well?
Lending. If you look at the data for the second quarter, the large banks' lending increase was a little over 1%. Not great. The small banks overall was about 8%. So really the small banks are the ones out there aggressively getting out there with customers and making those loans. That's what they're doing right, and that's why some of the stock prices are doing quite well.
You know, when we look at the Keefe Bruyette Bank Index, it's been pretty much on the rise since the beginning of the year. Do you see that continuing, and are there any stocks, big or small, in the banking sector that you're recommending?
We do think it's a pretty good environment. Interestingly, the valuations to a lot of my analysts in my group are kind of stretched, so they're getting nervous at this point in time. We were up 25% year to date, and after a good run last year. But remember that Keefe Bank Index is still 40% below its peak pre-cycle. A lot of that has to do with a dilution, but a lot of it has to do with this low interest rate environment keeping earnings down. Well, as interest rates start to rise, if home prices continue up, it's a pretty good environment. We think Citi's still a great investment. We think it's a great restructuring story and should do well in this environment. A little nervous about those emerging market issues, but we think it'll do fine. And on the regional side, there's a number of regional banks. We actually think you should look upstate New York right now. If you look up to Buffalo, there's a couple of banks we're pretty big on right now. First, Niagara, they've had a little bit of tough time, starting to turn around, and same with M&T Bancorp.
Let's talk a little bit about something you just mentioned a moment ago. It's a good lending environment for banks because they're able to command more on their loan rates, and their cost of securing deposits is relatively low. Another way of saying that is they've raised their loan rates, but they haven't raised their deposit rates. Do you expect them to raise their deposit rates anytime soon?
No, the banks are swimming in liquidity thanks to Ben Bernanke and the Fed. So we think that there's going to be plenty of deposits around for a long period of time. So if you're one of those savers out there, don't expect CDs to go up anytime soon.
That's what I'm asking. Fred Cannon, thanks very much, Director of Research at Keefe, Bruyette & Woods.
Great to be on. Thanks.
Thank you.
Big changes appear to be happening in Cuba. The hardline socialist government invited a select group of business journalists to get an up-close look at Cuba's economy and the reforms being made. So what's new and why now? Michelle Caruso Cabrera is one of those journalists on the ground in Havana, and she has our report.
Although the Cuban government says it is still fully committed to socialism, it invited business journalists here to show them some of the changes that they're making that actually take the government out of the economy. So one of the new reforms, individuals are allowed to no longer work for the government and instead start their own small businesses in select areas. So wherever you go, you now see little shops and doorways and windows. But just to show you how far they still have to go, the example that the Cuban government showed to the journalists was a storefront where they sold religious clothing and manufactured it in the back. The employees there working on 1950s-era Singer sewing machines, a testament perhaps to American manufacturing. The owner of the shop told journalists she's clearing $130 a month after all her expenses. That's a lot of money in a country where the average Cuban makes $19 a month. Other changes are coming in the transportation sector, where they're encouraging workers to form cooperatives to try to relieve the terrible, terrible situation with buses, which are packed and terrible for riders in the sweltering heat. Many are asking whether what's happening in Cuba right now is similar to what happened in China in 1980, when that country began its series of massive reforms. The Cuban government says absolutely not, that it will still always be socialist, and these changes are only to make socialism, in their words, more sustainable. For Nightly Business Report, I'm Michelle Caruso Cabrera in Havana, Cuba.
And if you want to know more about doing business in Cuba, log on to our website, nbr.com.
Still ahead, tennis, bridge, and options trading? Find out why more baby boomers are now do-it-yourself options investors and what they may be risking in the process. But first, let's take a look at how the international markets finished the day.
Soaring oil prices this week have already trickled down to higher prices at the pump. AAA reports the average price for a gallon of unleaded is now $3.55 nationwide. That's up 3 cents just since yesterday. That's the largest one-day spike since February, and experts say the pain at the pump is likely to get even worse this weekend.
Toyota's popular RAV4 small-sized SUV received an overall score of good from the Insurance Institute for Highway Safety. But in one demanding crash test, the RAV4 received the worst possible score. That was in the so-called small overlap test, which involves crashing a vehicle at 40 miles an hour into a 5-foot-high barrier on the driver's side, overlapping about a quarter of the vehicle's entire width. The top-rated small SUVs this year, the Subaru Forester and the Mitsubishi Outlander.
We focus now on some stocks with new highs and big moves in our market focus. Alexion rocketed today on a report that it's a takeover target. At one point, shares were up 23% to an all-time high. The company makes so-called orphan drugs. These are used to treat rare disorders. At the end of the day, Alexion gained 12.5%, closing at $114 and change. Also in healthcare, Athena Health jumped 20% to a new high. This provider of electronic healthcare software signed a new contract with a large healthcare system. Shares closed near that all-time high at $109.75.
And WebMD raised its revenue forecast for the year, saying biopharmas are buying more ads and sponsorships in its health information platforms. WebMD shares new high closed up more than 25% at $33.82. H&R Block got out of the banking business, selling to avoid the expense of stricter regulations, and investors said yay, and they said, let's move those shares higher, which they did. New high, triple volume, before closing at $30.63, up more than 2%. And after the bell, AT&T announced it is buying Leap Wireless for $15 per share in cash, a $7 premium over the closing price. Leap operates a prepaid wireless service, which AT&T will continue. The deal is subject to FCC review. Shares of AT&T were flat after hours, as you see there, while Leap shares, well, inevitably, they leaped, doubling on the news.
Well, our market monitor expects the stock rally to continue for the next 12 months. He's Eric Risterman, Chief Investment Strategist at Russell Investments. Welcome, Eric, onto the program. You know, we just reported on a whole bunch of new highs. This has been an amazing run for the stock market. What do you think is going to drive stocks higher over the next 12 months?
Well, a couple things, but I think go back to the source of strength in the markets this week, primarily because of Gentle Ben. But we didn't see that he said anything new in terms of the chairman of the Federal Reserve. What he said was that the economic news is getting better, the U.S. economy is getting closer to not needing the full stimulus of QE3, and that they're going to consider pulling some of that back. And we think that's good news for stocks. We think that'll be good news for earnings going forward, because we think that growth, economic growth, will accelerate both here and in Europe in the back half of this year. Plus, you know, the relative attractiveness of equities to fixed income and cash is still there. Those other asset classes don't look particularly attractive, and that'll probably drive some multiple expansion. So a combination of good economic data translating into good earnings and the fact that there's nowhere else to go probably drives stocks forward.
As you know, Eric, we've been asking our viewers to send in their questions about individual stocks, and we're going to start with one right in your backyard, which I know you must be familiar with. Robert B. in Long Beach, California, wrote in about Boeing. He asks, I would like your analysis of Boeing. The company has unprecedented backlog, costs seem controlled, future products are in demand, and U.S. carriers have aging fleets. That against the backdrop today of two incidents that really handicap the stock.
Absolutely. We're underweight Boeing. So why don't we hold as much as Boeing as people would think we might? The basic reason is relative valuation of Boeing versus other stocks that you can buy. Boeing, even with today's 5% pullback, which you noted earlier in the broadcast, it's still up 35% year to date. It's actually had a very good one-year return. We think that it's a good stock, a good company, just a little pricey at this level.
Okay. The next question from our viewer is about Sony. Linda C. owns Sony. She says, quote, saw your program for the first time tonight. We hope, Linda, you keep watching. She's new to the market, bought Sony back in December of 2012 at $12 a share. Now it's over 21. She wants to know, should I sell it or hold on? What do you think?
Well, that's another stock that we're underweight, and we're actually meaningful underweight. She may want to consider actually a company like Samsung. I mean, Sony, it's another story of their stock price recently has been spectacular. They have benefited probably in no small part in the consumer electronics industry from being in Japan, where Samsung's market in Korea has not done as well, and their stock hasn't done as well. We think Samsung's a better value than Sony.
All right, let's move to Missouri, where Matt H. Is interested in a company called Seadrill. He says, quote, I enjoy your show each weeknight and find it very informative. Well, we're grateful to you for that. Can you please look at Seadrill, ticker SDRL, and tell me about what the future looks like for the company and its dividend?
Let's tell viewers that they're an offshore drilling contractor. So they own oil rigs and they drill off those oil rigs. Then now what you've seen is business has been very good for them since oil prices have been relatively high over the last 5 years. In response to that, what they've done is they've actually taken out a lot of debt because oil rigs are expensive and significantly increased their capacity, which isn't necessarily a problem on its own. The problem is the industry as a whole has done that. So we think that industry is going to come under price pressure in the future because so much new capacity is going to come online. The other problem is this debt that they've taken on. It's going to be hard to refinance at lower interest rates. Interest rates are likely to move higher.
Okay, Eric, thanks for all of those good suggestions. We appreciate it. Eric Risterman, Chief Investment Strategist at Russell Investments.
Well, trading stocks and bonds is not easy. I probably didn't need to tell you that. But neither is trading options, which give investors the right but not the obligation to buy or sell financial products at an agreed-upon price at a future date. And since stock prices change all the time, it is a risky business. But as Jane Wells shows us, more people are diving into the options world, and they're not all young Wall Street hotshots.
Theta is going to be the change in an option's theoretical value for every 1 unit change in time.
In a library in Huntington Beach, California.
But you talk to a butterfly guy or calendar guy, what will they say?
Folks have paid almost $600 to indulge a hobby, trading options.
Volatility only affects time premium.
Dan Sheridan and Peter Lusk used to do this. Now they run seminars for the world's largest options exchange, the CBOE. Who shows up?
It's a male between the ages of 50 and 58. You'll get a few women there, maybe 3 women.
Why are boomers dabbling in options? Well, it costs less money than buying stocks. It's more exciting. You can get profits more quickly or lose them, and it's a way to manage risk. Bill Spillane is a former airline pilot.
I don't go to Vegas and gamble, but here you control your own risk. You set the rules.
But this stuff is tough to learn and easy to screw up.
I might be good on a trade 6 out of 10 times, and that's considered to be a good trader.
Oh my gosh, baby boomers are trading options. Red alert, sitting ducks, going to get ripped off, lose everything.
Well, right, and I'm concerned as an educator, start slowly. It's a business, it's a craft, and it takes a good year or two and many trades under your belt to get proficient at this stuff.
Look at that.
Take Steve Burnett, a 57-year-old pastor from Columbia, South Carolina, who traded stocks for many years and decided to kick it up a notch with options.
Studying dojis and candlestick formations.
Burnett settled on a strategy of selling puts, which allows investors to sell an underlying stock at a future date for a certain price for a fraction of the cost of the actual share price. It can be scary, like the time he meant to buy 5 Apple contracts and accidentally bought 105.
Which represents about $4.5 million. Scared the bejeebies out of me before I could sell that thing and get it off my books. I don't know how E-Trade let it go through.
Trading in Apple options may have been his scariest moment, but they've also made him the most money.
Nobody gets into it because it's boring.
Young men may play video games for excitement. Turns out their dads are also online in a game with greater risks and rewards. For Nightly Business Report, Jane Wells, Los Angeles. And coming up on the program, the one-year anniversary of Yahoo's new CEO, Marissa Mayer. This past year has been anything but dull, and we're going to look at how the company has changed and the challenges ahead. But first, let's take a look at how commodities, treasuries, and currencies performed today. Marissa Mayer has been experimenting with innovations at Yahoo, and they've stirred up a lot of controversy. She's been one of the most watched CEOs, and now, as her one-year anniversary approaches, we'll be hearing many reviews on her performance. So how's she doing? John Fort takes a look.
It had all the makings of a no-win situation. A Silicon Valley superstar was swooping in, trying to save the bad news bears of tech. But somehow, it looks like Marissa Mayer is pulling it off. A year into her stint as Yahoo CEO, the stock is up 72%. It's not because of some dramatic business turnaround. The genius of Mayer's first year is that she's taken a mediocre hand and played it almost flawlessly, communicating a vision, setting expectations low, and generating the right headlines at the right times. The year has certainly had its challenges. Right off the bat, Mayer announced that she was pregnant and would take minimal maternity leave while running the company. The pundits simultaneously praised her and vilified her. And then there was the work-from-home brouhaha. In February, Yahoo decreed that the relatively small number of workers with at-home arrangements, about 200 out of 12,000, would have to report to the office. The reason? Collaboration, coming up with new ideas, will be key to Yahoo's future. Critics, including Sir Richard Branson, pounced. How could an internet company squash telecommuting? Beneath the surface, though, Mayer's internal changes seem to be working. Free food, Friday afternoon staff meetings, and optimism around some key hires have helped boost morale. Glassdoor, which collects employee reviews, pegs Mayer's approval rating at 85%. Lower than Tim Cook and Larry Page, but higher than Larry Ellison and John Chambers.
The morale levels at Yahoo have improved significantly to the extent that she does seem to be a very, very well-founded and well-positioned leader with a strong strategic view for the company.
To keep a good thing going, though, Mayer will probably have to get Yahoo growing. Sales are flat since Mayer took over, and brand advertising, Yahoo's core business, is actually down. Wall Street's hoping for a little growth news when Yahoo reports earnings Tuesday. If Mayer can pull that off, year 2 will be off to a good start. For Nightly Business Report, I'm John Fort.
And finally tonight, you've been waiting. And they're back. Twinkies started arriving on select Walmart shelves today, months after Hostess Brands, their longtime banker, went bankrupt and stopped making them. But new private equity owners bought the rights to the spongy yellow delectables and other treats, and they're already flying off store shelves. Shoppers at a New Jersey Walmart were pretty happy to see the return of the Twinkie.
Look, Twinkies are back. As soon as it came on the Walmart flyer, here we are. They're like the best dessert one you can ever have.
How long they've been going? For a couple of years?
Now that I'm a grown man, the doctor said I can't have too many sweets.
I don't eat them.
Why not?
That's how I stay looking like this.
Doctor told me that I got to stay away from stuff like that.
Right here, America. I got one.
Twinkies can be found at retailers nationwide on Monday, with one big difference. The new Twinkies now have a shelf life of 45 days, nearly 3 weeks longer than they used to have. I'm not sure, Susie, that I should be comforted by that necessarily.
You know, this whole comeback is amazing. Starting on Monday from Times Square, they're going to have a bus tour. It's going to go across the country, giving away...
A Twinkie bus tour?
Giving away free Twinkies, and the mascot Twinkies will be there, too. I don't know what the mascot looks like.
How do we get on that route, to that bus route? Bring them by here. Bring them by Englewood for us.
That's Nightly Business Report for tonight. I'm Susie Garib. Have a great weekend, everyone.
And I'm Tyler Matheson. I'm going to go have a few Twinkies. Have a great weekend. We'll see you Monday.
Nightly Business Report has been brought to you by
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
I'm Susie Garib with a Nightly Business Report news brief. More trouble with Boeing's 787 Dreamliner. One caught fire on a London runway today. Another suffered technical issues that forced an early landing. Boeing shares fell nearly 5%. But blowout quarterly earnings from J.P. Morgan and record profits at Wells Fargo helped stocks make modest gains. The Dow added 3 points and the S&P was up 5, enough for both to close at new records. The Nasdaq added 21 points. But UPS surprised investors, warning that profits will be lower this quarter on a slowdown in the U.S. industrial economy and as customers find cheaper ways to ship goods. And Twinkies are back. They arrived on select Walmart shelves today, months after Hostess Brands and their longtime baker went bankrupt. Be sure to tune into Nightly Business Report right here on your public television station.